Oil is at $100. There's a war in the Middle East. Stock markets have been all over the place. Should you keep dollar cost averaging, keep your cash in the bank, or even buy oil stocks? Stay tuned, I'm going to answer all of this. So what's actually going on right now? As we know, February 28th, US and Israel launched attacks on Iran, and Iran responded by closing the Strait of Hormuz. That is that 33-kilometer wide choke point where 20% of the world's oil is carried through every single day. Of course, by closing that, it had a huge impact on the oil prices, which surged. The IEA, the International Energy Agency, which is the world's largest energy watchdog, has called it the largest supply disruption in the history of the global oil market. Oil went from $70 a barrel in February to a peak of $120 per barrel recently. Gas at the pump in the US cost $4 a gallon, up 38% since the conflict began. The US and Iran were recently in talks of negotiating a ceasefire, but those broke down and they couldn't reach an agreement. And since then, the US Navy has announced a full blockade of Iranian ports after those peace talks failed. And right after that, oil prices surged again. During this 2-week ceasefire, oil did drop sharply on that news. But here's the key word, it was just 2 weeks. It's not a resolve, it's just a pause. And in fact, that broke down recently. So this story is far from over. Now, what does this mean for stock market? The S&P 500 and the Nasdaq have held up remarkably well, considering what's happening. Markets dropped initially, and they recovered on ceasefire news. And now they're roughly flat or slightly down for the year. That indeed tells you something important. The stock market is not the economy, and it's not the oil price. It looks ahead. Morgan Stanley put it clearly. History shows that sudden shocks like wars, pandemics, and energy crises are often short-lived, with limited long-term consequences for equity markets. The key risk in all of this is duration. If this drags on for years, that's when it gets serious. If it resolves in months, then markets just shrug it off. The S&P 500 ETF dropped about 8% through March during the peak of this crisis. That's real, and that hurts investors. But here's what happened the moment that ceasefire was announced. SPY jumped 2.5% in a single day, and the Dow gained over 1,300 points. That's the fastest single-day recovery of the year. Meanwhile, energy ETFs told a completely different story. The Vanguard Energy ETF has actually outperformed the S&P 500 by 30 percentage points since the year to date. Oil and gas exploration ETF are up over 10% in a single month. And the honest picture is if that you hold the S&P 500 ETF or any ETF which covers the S&P 500, things like the Vanguard VTI Total Index, the Vanguard Total Index, which is one of my favorites, then you're going to be slightly down on the year, roughly 1% as of now. And that's not a disaster, that's just noise. This is the markets, they go up and they go down. But we're talking about long-term investment on this channel. And ETFs are one of the greatest methods of long-term investment. Now, if you're holding stocks such as gas and oil, then obviously those are exposed quite significantly right now. And also stocks that are exposed to energy costs, such as airlines, shipping, manufacturing. And again, that's normal and temporary for certain stocks or ETFs to be exposed to risks at certain periods of time, depending on what is happening in the world, or particularly US markets. Now, should you buy oil and gas stocks? This is a question everyone's asking right now. Oil is at $100 a barrel. US energy producers are booming. US oil exports just hit a record of 7.9 million barrels per day as the world scrambles for alternatives to Middle Eastern oil. So it sounds like an obvious buy, right? Invest in those US oil companies, invest in those US energy companies. But here's the problem. By the time you hear about this opportunity, it's already been priced in. It's already too late. Oil stocks have already run up significantly. You're not getting in early, you're getting in after. You're getting in at the peak of FOMO. The second problem is the ceasefire. If the Strait of Hormuz reopens fully, and that's what the US is demanding, then those oil prices will drop back down sharply. Analysts project that oil prices will drop to $80 a barrel if that happens. So you may indeed buy them at the peak of the crisis, at the peak price, and then that value just falls massively when the situation is resolved. For me personally, I'm not interested in buying oil stocks. They're too volatile right now. They're too unpredictable and they're too exposed to what's happening in this geopolitical situation right now. And that is going backwards and forwards, as we know. War starts, 2-week ceasefire, apparently war is going to happen again. And ultimately, my take is that you should expose yourself to the best long-term investments. And the best long-term investments are companies that are more exposed to growth. not fluctuation. History and philosophy behind this. Every generation faces a moment that feels like the end of something. 1973 oil embargo. Arab nations cut off oil to America. Lines were around the block at petrol stations. Markets crashed and people said it was over. It wasn't. The 1990 Gulf War. Oil spiked, recession fears, same panic scenario, and it resolved faster than anyone expected. 2001 September 11 terrorist attacks. Markets closed for days. People said capitalism was finished. S&P 500 is more than 500% higher since then. The Roman Emperor Marcus Aurelius wrote that during a time of plague, war, and constant crisis, that you have power over your mind, not outside events. Realize this and you will find strength. He wasn't talking about investing, but he was describing exactly the investor's challenge. You cannot control situations in the world. You cannot control politics. You cannot control oil prices, but you can control your response. And the investors who made money through every one of these crises had one thing in common. They didn't try to be clever. They didn't try to rotate their investments into oil stocks or everything into cash. They held their positions. They kept investing and they let time do the work. They let things compound. They stayed patient. They didn't react. They stuck to their strategy. They held to their beliefs. There's a famous story about JP Morgan, one of the most influential bankers of all time. Someone asked him once, what's the market going to do? And he said, it will fluctuate. That's it. That's the entire answer. Not a prediction, not a strategy. Just that it goes up and it goes down. It always has. And it always will. Now, here's what that actually means to you practically. If you sell when it goes down, you lock in your losses permanently. If you panic and sell based on all of this stuff, you've lost. For example, you see, oh my God, the market dropped 8%. You panic and you sell, you get out. Then you've lost that minus 8% for real. But then, hey, the ceasefire gets announced and it shoots back up 2.5%. Then it goes higher and you're sat there with that smaller amount of cash, calculating, oh, if I'd have just held it, I would have been okay. But that fear trap is the trap that most people fall into with investing. I've fallen into it myself many times. I've seen the speculation. I've seen the hype. I've watched it crash. I got scared and I got out. Now, at a certain point, you have to be realistic and say, you're willing to lose this much. But at sometimes you have to understand that things fluctuate. Things will go back up. It's not always going to be doom and gloom, especially for large ETFs and long-term investors. But then you may ask, so when do you actually sell? There's 3 situations I consider to sell it. One is that you need that money specifically for something right now or within the next 12 months. And even then, I wouldn't sell the whole thing. I would sell a margin of it, a small percentage of it. Ideally, you don't want to have money in the stock market that you're going to need anytime soon. You should have a rainy day fund, good health insurance, and common sense. A number 2 scenario is that the fundamental thesis of the company that you originally invested in has broken. Not that the price dropped, it's just that the business itself is deteriorating. At that point, you want to make a calculated loss. You can see that the company is dying. Now is the time to get out. And like I said earlier, you would have that. Am I willing to lose 50%, 70%, 100%? When I see things are going down and that company appears to be a burning ship, it might be time to get out. Lastly, 3rd scenario is that you're rebalancing your portfolio. You've made significant gains in one position. Sometimes I would encourage you to think, how much do I want to gain from this? Do I want to double, triple my money, 1,000 exit? When you hear some of those things, maybe you might want to consider taking a small profit. You don't have to sell the whole thing, but take out a little bit and enjoy, or use it for whatever you want to use it for. That kind of thing is disciplined and not emotional. So that's when to sell. What about when to buy? My strategy is find companies and ETFs that you believe in and just dollar cost average into them. Buy them at specific times each month. Don't look at the price, just buy it. Now, I will say sometimes maybe I'll put, let's say I have $1,000 to dollar cost average. I may put 50% in at the current price and then put a market order for a little bit of a lower price. And then I'll give that a period of 14 days. And if it's not fulfilled, then boom, I just buy it at that price that it is currently. I don't want to waste time. I'm not looking to be actively involved. My strategy is long-term investing, and that's what I promote. But dollar cost averaging is also my strategy. And that's just buying it at whatever price it is at the companies, the ETFs that I believe in currently. And in short, the answer is sell almost never and buy consistently. That's really it. What about cash in the bank? The last question I wanted to answer is that times of crisis, people think about banks are not safe. maybe I need some cash, maybe I need some gold. What do I think about that? It's a question a lot of people are asking. Prepper guides, survival guides, the world's ending, etc., etc. The problem with that is that inflation is running at 3.4% and rising because of the oil shock. If your savings account is paying 4%, you're already beating inflation just by having it in a savings account in the bank. So just understand that cash is not a safe haven for inflation. Just by having cash, it devalues over time. But that doesn't mean that you should keep zero cash. I do think it's smart to keep maybe $1,000 in cash or gold in your house. Just make sure you store it somewhere securely and only you know about that, and consider it as an emergency fund. $1,000 or maybe 3 to 6 months of emergency funds, and just consider it as survival money if the world goes apocalyptic or something like that. You never know. Also, alternatively to physical cash is gold, but gold can be also a hassle as well. I went past 2 gold shops the other day and the queues were around the corner just because it's like this commodity situation. Prices are so fluctuating on this stuff that people just kind of go crazy about it and like run, oh my God, the price is so low, and that can kind of happen. And then if you're thinking like you needed access to cash right now and you had a piece of gold and you had to go and deal with that stuff, it's not ideal, and they may be short of cash. So I think cash is still king. Probably quite a smart move to keep $1,000 to $3,000, $10,000 just in hard cash sitting in your house. Should you keep DCAing? So with your emergency fund sorted, does that mean even through volatility, you should keep dollar cost averaging and investing? Yes, always. Dollar cost averaging was always a perfect strategy for times like this of uncertainty. When the markets are uncertain, volatile, and scary, DCA takes the emotional side out of it. You invest the same fixed amount each month, whatever that's comfortable for you to invest, regardless of what's happening in the Middle East, regardless of what Trump says, regardless of anything else. When prices are up or down, you automatically buy into the companies that you prefer. Like I said earlier, set aside a fixed amount each month, find companies and ETFs you believe in, consistently invest in them, buy at the market price, put a little bit for a market order, lower. If it goes lower, great. If it doesn't, wait a few days and just buy again at that market price. Keep it simple. The worst thing you could do now is just get scared and stop investing because you think everything is too unstable. But here's the thing, it's always going to be uncertain. No one knows where things are heading. In 2020, it was COVID. In 2022, it was interest rates. In 2023, it was banking collapses. In 2026, it's the America-Iran war. There will always be a reason for people to pause. But the people who stay consistent and never pause are the ones who build real wealth. Those who wait for pauses and for certainty are the ones who miss the recoveries, are the ones who don't consistently stack their investments. I'm not changing anything in my strategies. And I'm not buying all stocks. I'm not moving everything to cash. I'm doing exactly what I was doing before all of this crisis. Consistent dollar cost averaging and watching the fundamentals of the companies and the ETFs that I believe in. This war won't change my fundamental beliefs in those things. So why would it change my strategy? And lastly, this is not financial advice. This is my own personal thinking about it. Please do your own research into the companies that you intend to invest in. Please invest what you're comfortable with and understand the impact of that. And don't let news headlines or people's opinions make your investment decisions for you.